Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Dave Erfle, and well, we have a lot to talk about in these markets because it is a sea of red out there. U.S. equity markets are down. The Russell's down almost 3%. Nasdaq's down 3%. The S&P is closing in on being down 2%. And we also have the metals down. Gold has actually fought its way back. That's only down about $7 right now. Silver is down close to $1. Copper is down almost 3%. Crude is down almost 4.5%. And the stocks, well, they're following this sea of red lower. Dave is the founder and editor of the Junior Miner Junky. Click the link in the show notes to visit his website. Dave, what do you take away from a day like today to kick off September when apparently all the traders are back at their desks and it seems like they're all hitting the sell button?
Yeah, it's really not surprising. And I warned my subscribers last week that look out for September because notoriously and historically, mostly since 2017, the gold price has been down every single September. And September is easily the worst month for the gold price. I don't know why, but that just seems to be the case. Traders come back from vacation and they see a lot of profit in gold. So they're taking it here today in gold stocks and especially silver. Like you said, the gold price has already bounced back quite a bit. I mean, it tested 2,500 and it's come right back. But silver and the gold stocks are selling off with the stock market, which makes sense because they rose with the stock market, especially the gold price. It rose along with the stock market. So profit taking coming in here today. And I know I mentioned in last week's discussion that we had a monthly close last Friday, and the gold price closed above its monthly Bollinger Band for 5 of the past 6 months. RSI on the monthlies it was at 77. So I wanted to see some profit taking here because it's healthy and it needs to happen because the higher it goes without some profit taking, the sharper the correction usually is. But I also mentioned to my subscribers, hey, that I had hold ratings on all the stocks that I cover for the past month or so, and I said that now's a good time to probably put in those stink bids if you're still accumulating. And it's already started here on the first day of the month.
Well, Dave, let's dive into that a little bit more because I'm sure people listening understand that gold probably needed to correct a little bit, although I would submit to your point, it's not really correcting that much right now. But the gold stocks, the silver stocks, and silver itself have been correcting a lot. I don't know that there's a lot of profit taking in it because there wasn't a lot of profits to begin with. But what would you do from the psychological standpoint as far as where would you put stink bids? Where do you look at scaling into positions for people that see the sell off and think, okay, well, maybe I'd like to deploy some money. It may be too early now on the first day of September trading to really start averaging in, but where would you look at averaging into some of these stocks if you wanted to add to positions in the weakness?
Well, it depends on the stock as far as stink bids in individual stocks are concerned. You look at support levels. If it's something that has been trending upwards and bifurcating from the sector, because a lot of these juniors have, you look at downtrend lines. I'm sorry, uptrend lines, and maybe the last price that the stock bottomed on that uptrend line. And if it breaks that uptrend line, then you start to look for where the previous top was in the stock. So as far as the miners are concerned, that we've seen several of the miners that were bifurcating and going higher and making all-time highs that were really overbought. I mean, it makes sense for them to come off here, and that's what's happening in your Agnico Eagles and your Wheaton Precious Metals. So uptrend lines, for one, are a place to start adding. They could get hit even harder because it all depends on how much panic selling comes into the marketplace. So, like I said, it's an individual case by case basis on each stock that you're considering accumulating. But some of these things got really overbought. You might want to wait to see what happens here because this is just the first day of September, and a lot of these have come off quite a bit. What we have the GDXJ down over 5% this morning. So, yeah, I mean, you might want to just wait to see how much selling comes into the market before starting to think before you start thinking about placing stink bids.
So, Dave, when you talk about stink bids, then if you're not even placing them yet, Everyone just wonders, well, how much lower can these stocks go? It's hard to tell, but it also talks about time frame too, because look, in a way of a bull market, this bull market, you can argue, is playing out the way it should, where the majors are starting to run, some of the high quality mid tiers are running, the juniors have not started running yet. But we need to look at time frame too, right? Gold has been doing well for like 8 years, almost 9 years. The stocks have been doing well, arguably just since March, although you could go back to last year. How do you balance out time frame of this bull market?
Yeah, I mean but they still got a lot of catching up to do, right? So as far as time frames are concerned, it's a big reason why the gold stocks haven't done nearly as well as the gold price is because of those margins, right? I mean, that inflation that was so bad and it really hit those margins for these mining companies. I think I talked about this last week. The gold price in relation to WTIC ratio, the gold crude oil ratio, the gold commodities ratio, and even the gold S&P ratio. We've seen the gold CRB ratio at a multi-year high, the gold oil ratio at a multi-year high, and you've seen gold really beginning to outperform the stock market since the gold breakout above 2100 at the beginning of March. So I think the gold price needs to get above 2700, which is right around where the CPI adjusted gold price is, because we had that 13-year break, a cup and handle breakout, which was very significant in the gold price. But the gold still hadn't reached its CPI adjusted high, which is right around 2,700, and that would be a 45-year high. So we had a 13-year cup and handle breakout, which is extremely important, and then it's very rare to have like a 45-year breakout in anything, and seeing a gold breakout, a CPI adjusted gold breakout above 2,700 would be a 45-year breakout, and that's something that would really get a lot of attention in fund managers and big money traders, because they've been watching the gold price go up, but it hasn't been going up as fast as inflation. Well, since the gold price broke out above that 13-year cup and handle, that's when it started to go up faster than inflation. So that's why the last 2 quarters for the miners have been really good, because their margins have really increased. They've already shored up their balance sheets. They got very healthy balance sheets. So those margins increasing, that is really going to is really helping out the majors, and these fund managers are finally going to have to take notice, because we've had 2 consecutive quarters of really good returns for these miners, but the stock market is yet to roll over. So that's why these generals really haven't paid attention to gold stocks. They're like, why should we mess around with gold stocks if we keep doing really well with general equities? Well, now that the AI bubble is obviously popping here, I think that's finally starting to affect the stock market here on the first trading day of September, because some of those profits from AI have been rotating into small cap stocks, but they've yet to really rotate into precious metal stocks. So we need that to start happening. And once that starts happening, then it'll eventually trickle down to the juniors that haven't moved yet. Sure, there's been several juniors that have moved. They've bifurcated from the sector and they're doing really well. And they're seeing some profit taking here today. But we need the junior sector as a whole to start doing really well. And that's not going to happen until the stock market rolls over. And of course, that's going to hit the juniors. That's hitting the juniors and everything else today to begin with. But eventually, it's the gold stocks that always come out of it first once we have that rollover in the stock market. I mean, if you take a look at an example of 2008, where we had the last major panic in the stock market in October of 2008, gold stocks and the stocks and everything was selling off. But gold stocks bottomed in October of 2008. But the stock market didn't bottom until 6 months later in March of 2009, and several gold stocks had already tripled and quadrupled by that time.
Yeah, David, it'll be interesting to see if the gold stocks can recover quicker than the general equities if there is an all-around sell down in the markets. But to your point about the margins, These aren't just increasing margins. These are the biggest margins we've ever seen in the mining industry for gold stocks. The average all-in sustaining cost right now is around $1,500 to $1,600. We're at $2,500 gold. That's a $900 to $1,000 spread. That is bigger than 2020 when it only had an $800 margin average. That's way bigger than 2016 when it had about a $450, and bigger than 2011 and 2010 when it had $450 to $650 for 2010 and 2010 and 2011 respectively. So these are the biggest margins we've ever seen in gold stocks, yet they are nowhere close to their 2022 peak in GDX, to the 2020 peak, and way nowhere close to the 2011 peak. So is there something going on besides just margins? Because for margins, you couldn't ask for better margins than we have today.
Yeah, it's what I mentioned before. It's the stock market that continues to make all-time high after all-time high, and it doesn't really give generalists the impetus to go anywhere else. And also, you've had crypto take the wind out of the junior sales for quite some time now. So there's been other places for speculative capital. So that's the reason why you see these really low volumes in the juniors. Just take a look at the venture. I mean, it's got the lowest volumes that I've ever seen, and I've been following this market for over 20 years, and it's the lowest volumes I've ever seen in the venture, and the TSX venture is made up of 50% mining stocks. So we need to have more speculative capital come into the sector, and that's not going to happen until the stock market rolls over, and they need a reason to go out and look for an alternative for their speculative capital.
Dave, I hear you, but fact of the matter is I've heard that for my whole career in the resource sector. If only more of the generalists cared, if only some money rotated in. We need to face it. This is a small sector, and yes, any money coming in does help, but look, you even alluded to it here where we look at the gold to S&P ratio. That's flat ever since just 4 years ago when gold is taken off here, but so have the markets. And quite frankly, gold has completely underperformed the markets for quite a while. Then I think we do need to focus on what your strategy is within the companies. Do you see then any opportunity in some of these optionality plays? Companies that have been around for a while have a resource that really wasn't economic at some lower prices, but now that margins have expanded and the gold price is, well, at all-time highs or right around those levels, do these optionality plays offer some leverage, some opportunity in your eyes?
Yes, but you have to be a good stock picker as far as optionality plays are concerned, right? I mean, you have to be in the companies that are really well run by strong management teams that know when to raise capital, that haven't over diluted already and taken much of the upside out of the stock. I mean, a lot of these stocks have been treading water for a long time, and they continually have to raise money. So a lot of these companies have found alternative ways to raise money without having to dilute so much or dilute at all, selling off non-core assets or doing gold-linked bonds, or they found these other ways to raise capital without over diluting. So you look for these companies that have been avoiding the over dilution, because there's several companies that I still hold that when I started to accumulate them, they had 3 to 10 times upside potential. But while I've been holding them, they haven't moved very much, and they've had to raise money. So a lot of that upside is gone now. And some of these companies that I've been accumulating are going to end up being failed investments. And what I mean by failed investments, I view a failed investment as any stock that hasn't at least tripled by the time this cycle is over to losing money on the stock. So before I invest in something, it has to have 3 to 10 times upside potential. But now with so much dilution coming in, as the juniors have been treading water for so long, some of them don't have that much upside anymore. So I look at them as failed investments, even though I still might make some money on them.
What about M&A, Dave? Because some of the seniors and especially the mid-tiers are more cashed up now. Like you say, their balance sheets are better than they've been in a decade. Why aren't we seeing more deals like we saw with the Goldfields takeover of Cisco Mining, grabbing some of these other companies with ounces in the ground?
Well, I think we will. We've got conference season coming up here. We got Beaver Creek next week. That's followed by the Denver Gold Forum. I think there's going to be a lot of management teams discussing M&A. So I think we're going to see a couple of M&A deals come out of these conferences, and that might heat up the sector a little bit. I mean, once you had that that Goldfields take over the rest of Cisco mining, you did see a pop in a lot of the late stage juniors where the speculators took their capital because it being an all cash deal. They went ahead and took their profit, and they put that profit into companies that they expected to be next on the takeout list.
Yeah, that was a nice boost to a number of stocks, and quite frankly, we have seen quite a bit of M&A. We've been talking about M&A Monday a lot over the last little bit. It's been the higher quality companies. I think we're all just waiting for one of those non-resource companies to get taken out at a multi-billion-dollar valuation to signify the top of the market, but hey, we're not there yet. These companies that have been taken out are well-known projects, and they still seem to be very economic. But most everything is looking economic at some of these prices. Dave, thanks for your time. We'll try to chat with you next week, although I know we'll all be in Beaver Creek, so it'll probably be a couple weeks from now, and we'll get to see where these markets lie. Again, click that link in the show notes to visit Dave's site, Junior Miner Junky. Dave, great chatting with you this week. Hope you have a great rest of your week.
Thanks, guys. You too. See you next week.